I think we will start the session now. Good morning, gentlemen and ladies and gentlemen. Welcome to the discussion on Anwar Ceramics third quarter financial results and the causes for the decrease in the profitability. Okay, so just I would like to start with a small brief saying that first of all, the gross revenue on the operational side, I would like to highlight that the company has been doing extremely well. For the first 3 quarters cumulative, the company's revenue has grown from 19.285 million to about 21.345 million, representing a growth of about 11%. And profit from operations also has grown by about 7% during the same period, from 4.384 million Real Omani to about 4.689 million Real Omani. So on the operational side, the company has been doing well and there are no cause of concerns. And on the expansion side also, we have already commissioned the plant fully and the trials have already started. And from this quarter, we should be able to appropriate a part of the production. And from the next quarter onwards, we will be able to appropriate the entire capacities or at least a substantial part of the capacities going forward. Coming to the, we had one time, a fair value change, which we had to account on our investments. So that is why there was a sudden drop in our profitability. This is unrealized fair value change in our profit, which has been taken through profit and loss account as per IFRS 9. So that was totaling to an amount of about 3.276 million Real Omani. So based on that, the profitability went down, but this is, as I said earlier also, it is unrealized changes in fair value. So we will discuss that in detail, a little more in detail as we go along, as and when we have any questions on this. Okay, and now I leave the floor open to the investors and the analysts if they have any queries or any questions for us to answer. Yes, gentlemen.
Hello.
Hello. Yes, Bishan.
Good morning, Mr. Suresh. Hi, this is Bishan Bhalla from Vision Capital. How are you?
Yes, fine, thank you. Fine, thank you so much.
Great. Thank you for this initiative and thank you for this call. I think it's extremely helpful. And as you would be aware, the primary discussion point for today would be, on sort of this investment. So I had a few questions. I'll go one by one. The first is you mentioned that this is an unrealized loss. Could you just sort of elaborate a bit more on that in regards to sort of what is the further downside or upside from these levels? What is it that drives this particular investment? If I'm not mistaken, it's approximately close to 9.7 million reals in terms of the total size of investment. So if you could just highlight in terms of this 3.2 million real that we've seen, from that level, what is the further downside, upside? What drives it? What is the underlying? And more sort of importantly for us as investors, what was the rationale for sort of, if I understand correctly, of whatever limited I've read, these were auto call notes which effectively give you a debt return with sort of and as we've seen now, an equity downside. So what is the rationale for doing this rather than going for a plain vanilla 4 to 5% bond? If you could just elaborate on these two, and then I'll follow up with more questions.
Okay, fine. So no, it's a very important question which you have raised, Vishan. See, basically these investments have been there with the company for the last couple of years, and then the company has got a return, a very, very decent return on these investments. In fact, if you see last year, we had on the same investment, we had a return of almost 1.3 million or 1.6 million reals. And this year already we have a return of almost more than 1 million reals from these investments. So having said that, these investments are, like you pointed out, are callable notes with underlying equity with a base index pricing. Okay, so any movement on those base, the underlying equities will impact the valuation of the investment, which is as per IFRS, we need to take that as through profit and loss account. IFRS 9 is clear on that. Having said that, these have a fixed maturity of 2 years. The maturity of these things coming up from the next 4 months or 5 months to about the next about 15 months. This is the maturity of these instruments. So at the time of the maturity, what happens is that if the underlyings, there is a barrier strike rates. If it hits the barrier strike rates, then there is a formula which will apply. And as per the formula, the returns will be based on that. And till the barrier strike rate hits, the coupons will be accruing to us and it will be paid to us on a regular basis, on a quarterly basis. This is how these structured product work. So as of date, the valuation of the underlying of all the notes which we are holding together, we had to have an impairment of 3.276 million. But these, as of date, if you see, it has considerably improved. In fact, the impairment has reduced as of date. But I cannot give you a fix as to whether we will be, whether it will go, it will further improve or whether it will further deteriorate. But going by the history of these notes, uh, traditionally, we have never lost a penny in these notes till date. But that, having said that, I cannot say that we will not lose going forward, or what we have already impaired is whether that will be the impairment or whether the impairment will be lesser or the impairment will be more, depending on the underlyings. But as on date, I can say that it has the impairment has reduced from what we had reported in September.
Now, when you mention of, you've not lost money on these from the time you invested, you're talking of 2 year for 2 year time period, because you started investing in these over the last 2 years. Is that correct?
Yes, that's right. From 2020 onwards. That's right. Yes.
Correct. Understood. So from 2020 till date, whatever has matured, you haven't lost money, and I understand that because global markets are such. Now, if I were to understand correctly, last year when you mentioned you made 1.6 million on a 10 million investment for an auto-callable note in a structure, effectively that was the equity upside on the reverse side, where basically, like how you have a strike barrier on the lower side, you basically made an upside along with the coupon. That's how you made the 1.6 million.
No, Bishan, that is not the one. What I said, 1.6 million is only the coupons, because there was no upside as such. There was no material upside in the last couple of years. This is the first time that there has been a downside, so we had to report. Okay, so there has been no material upside or downside in the past, because they were all hovering around the same levels. And what income we have reported is purely realized coupon income. And this year also we have a realized coupon income of more than 1 million. That's what I meant.
Okay, if you can just elaborate that on a 10 million real investment, if you have made coupons of 1.6 million, that is a 16% coupon.
That's right. That's right.
How is so sort of what now that's the part that I'm a bit surprised about.
Yeah.
What is and sort of more importantly, I mean, I get it, we have different companies investing in different products which are complex, but for sort of a plain vanilla investment book like yours, as an investor would expect, it's very difficult for us to make sense of what the future lies ahead.
Yeah.
Purely because we have no idea about the underlying. If you could just throw some flavor on that, because today we have no idea what the next quarter or the next 6 months might look like, because we have no idea about the underlying. If you could just shed some light on that.
See,
what is the underlying, and how does
underlying,
one sort of go about that?
Okay, fine. Yeah, it's a fair point. I mean, the underlying basically are very, very, high yielding and high market cap US securities. Okay, or US equities, basically like, Amazon or, SPG or something like that, which are all multi-billion market cap equities. So we are also very, very careful in choosing those underlyings. And then we have a team, from our chairman's office also ensuring that all these things are, vetted properly before it is being invested. So to that extent, all are multi-billion dollar market cap underlying equities. So these are the things that, we don't look at small equities. Sometimes in the past, we have invested on the indices itself, like the New York Stock Exchange indices or NASDAQ indices itself. But of course, that is all history. Now we don't have anything on those indices as such.
And as I understand, these are sort of multiple structured products. It's not just one single structured product. These are multiple structured products with varied
That's
maturity
right.
dates. So,
That's
and
right.
which would
That's
start
right.
maturing between 6 to 15 months.
That's
So,
right.
so the one that
Four to
is
6 months.
closest,
Yes. Yeah.
4 to 6, yeah. So the one that is closest to maturity,
Yes.
sort of. Now, as of date, you mentioned you took an impairment in previous quarter, and as of date, it is up from that sort of. It's up from the last impairment or the last base value that you
Yeah.
reported.
That's
Now,
right.
now what happens in, we'll start with that one, and of course the same applies to the others. What happens on sort of maturity date? Let's say if it's below this barrier strike price, what
Yeah.
happens to the coupons? What happens to the 100? So let's say if I invested 100, that
Yeah.
100 went to 70 and you reported a loss of 30. Today
Yeah.
you're saying from 70 it's gone up to 80. Currently,
Yeah.
there's still a
Yeah.
month and a half to go.
Yeah.
It might end up anywhere. So could you give
Yeah.
me could you explain on sort of 31st December or on maturity date,
Yeah.
if that 80 goes to 70 or 60 or 90, what happens to the value
Yeah.
and what happens to the coupon?
Okay, I got it. So see what happens to the principal in the first list. Let us come to the principal point of view. See, as long as it does not hit the barrier strike rate, for example, 60 or 65% of the underlying. Okay, till then you get 100% return on your principal. So there will be no loss on your principal. So till it reaches the strike rate, the strike rates varies between 50 to 65% depending on the note. So which means even if the underlying goes below 50%, only then there will be a formula applied. Till it goes to 50%, your principal is guaranteed of 100%.
That's the first part. Now the
That's
coupon.
Yeah, the coupon also, if the strike rate is below 50%, the coupon gets accumulated and then it gets paid once it hits the coupon, the strike rate, whatever is the strike rate. It gets added on, it doesn't get deleted at all. It gets added on till it hits the strike rate. Once it hits the strike rate, you get all the coupons, including the pending coupons, which has been missed out, if any.
So in a worst case scenario also, whatever coupon was there will come to you irrespective of what the underlying final price of your 100 is.
Yes,
Is
unless it has gone below the strike rate. Yes, what you are saying is right.
Okay, so now what has happened in Q3 is that the 100 went below the strike price of, let's say, 60. So let's say
Yeah,
the portfolio value was of all those underlying securities combined for the structured product was 55, right?
yeah.
So now, because it was 55, you had to, as per IFRS, recognize that
It
even
is
though it's
not the
unrealized
strike
in
rate.
equity.
Vishan, I would like to highlight two things. There is
Okay.
a difference between the strike rate is different and the valuation of the underlying is different.
Okay, fine,
Okay,
understood.
so
So
which means that your
yes,
coupons
please
you still
elaborate.
will be getting it, whereas because the underlying has not hit this hit the what do you call strike rate, your coupons are you are still getting it. Whereas because it has gone below the 100% and still not hit the strike rate, you
Got it.
have to
Perfect.
account the deficit through profit and loss account as per IFRS 9.
No, very loud and clear, understood. So if I may just to sort of elaborate on that, the 100 might have gone to, let's say, 80. So
That's
you
right.
have reported the 20, the drop of 20, but the
That's
strike
right.
is
Yeah,
60. So you still have a
that's
buffer of 20, right?
that's right.
Now
That's right.
that would mean that over the last 2 years that you've been reporting this, we have not seen a drop like this in your P&L, which means
Exactly,
it's always
exactly,
been above
because
par.
there has been
It,
no material
no material downs.
no material differences. That's
So
right. That's right.
your par has always been sort of intact, and the
Intact.
upside
That's
doesn't
right.
need to be reported because it's a structured product. It's only
That's
when
right.
it goes down due to
That's
the
right.
latest valuation.
That's right.
Now,
That's right.
okay, now
That's right.
how far are we? Okay, so if you could, the next question, and I'm sorry for taking so much time. The
Yeah.
next question is when this 100 actually hits the strike price of 60, which is currently probably 80 or 70.
Okay.
Now, on that day, of course, what you do is you do report the further impairment, which is from
That's right.
80 to 60,
That's
right?
right.
Now,
That's
let's
right.
say on maturity date it actually hits 60. So,
Yeah.
what is the overall? What do you get back only 60? And what
No.
happens to the coupons? If you could just explain these two things.
No. If it is the 60 is the strike rate, we get the 100% of the return and the 100% of the coupons.
No, let's say 55. I mean anything
Say
below strike.
55.
So let's say
Yeah.
55. Yes.
Anything below 55 means there is a formula by which if it is going strike rate is 60 and you are at 55, then there is a formula by which probably in this case it will be like I'll tell you. About 91% will be your 92% will be your return if it is if the strike rate is 60 and if it goes to 55.
Okay, wow. So even for a haircut of 50% on the overall valuation,
That's
you
right.
still get 90% of your money back.
That's right. That's right. That's right. That is
But
why I
not with
said,
no
well,
no
that is
no
why I
for
said the valuations are
the
totally
coupon.
different from the strike rate calculations. Yeah.
Okay, okay, understood. Right. And sort of, I mean, what kind of buffer do we still have between your strike price and your latest reported value? When I say latest, I mean where we
There is
stand, because what
there,
you
there,
reported is
there there is
unrealized
there is a
portion, so
there
we
is a
look at latest.
substantial benefit. Yes.
So as long as, like, to repeat my example, as long as you were at 80 at the end of Q3 and now you're at 85, which is significantly above the 60, you would
Yeah.
get the entire 100 back, and
That's right.
you would get,
That's right.
so effectively then on maturity, this 3.2 million that you have reported, which is probably 100 going to 80, if on
Yeah.
maturity it remains at 85, you get the entire 100 back. So
That's
do
right.
you
That's
reverse
right.
this entire 3.2 million that you reported? How does that, how will
Obviously,
that work
obviously
at
on
on maturity?
maturity, see the valuations we need to keep reporting as far as it is material. Okay, once
Right.
the maturity happens, and then depending on the maturity, we will be reversing to that extent, because these notes are maturing between say 4 months to 16 months, as I said. So when
Yes.
that is the case, so what happens is that as each maturity of each note will be accounted, and then whatever is the impairment we have, we will be reversing it to that extent. Or if there is a more impairment, we will have to account that impairment more.
Okay. So on maturity, as long as you're above the strike price, you go back to 100, and all those unrealized losses are sort of reversed.
That's right. That's right. That's right.
Okay. 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 That's it on at least this. I'm sure my peers will have further questions. Now, on the operating side, if you could just elaborate on how things are panning out when it comes to the custom refund from Saudi, or sort of how do those things stand over there?
Yeah. 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 See, coming to the operational side, in fact, the company is doing extremely well. But then there are a couple of challenges which we had also pointed out in our chairman's report, where one is on the customs duty that has been imposed by Saudi Arabia, which is really challenging. And then it is not only for us, it is for all the manufacturing companies in Oman. We have been making representations to the government to see how we can resolve it, but there has been no resolution as of date. So which means that there is a impact on our volumes in Saudi Arabia. But having said that, we have now very, very strategically, we have moved to see how we can diversify into other markets. And then we have been quite successful in diversifying part of it in other markets. Though the realization in Saudi is going to be a little challenging, and we may have to take a small hit on that. But we are hopeful that it will be compensated in the other markets which we have entered now. And the second point is on the revoking of anti-dumping duty in UAE. There, that has also impacted the volumes and realizations to some extent. So there also the same, as I said, the other markets is what we are looking at to fill in those gaps. But at the same time, UAE is anyway was not a very big market for us even going ahead, unlike Saudi. So
Right.
with the additional capacities, especially with the additional capacities, which is now already we have commissioned and we have already started production, we have the larger format tiles, which is available now with us. So that is getting a little more traction in Saudi Arabia. So to that extent, whatever we are losing in our regular traditional sizes, now hopefully partly we will try to make it up with our large format tiles. So there has been quite a traction on that, and then people have started visiting us, and then already it has started moving quite well. So this
Right.
is where we stand on the operations.
And in terms of utilization, I mean, you already had high utilization before the mobilization of the expansion, the 3.5 million square meter.
Yeah.
Sort of what kind of blended or combined utilization do you see for 2023, given sort of the revoking of anti-dumping and this current limbo in terms of sort of the Saudi refund?
In fact, we are looking at a full utilization. I mean, that is what we have envisaged. We are very confident that one line what we have added we should be able to because these are all large format tiles, and this has got a different market for it. And then we are very confident that we will be able to run a full capacity on all our lines for 2023. The only question is on the timing of the next expansion. In fact, I mean, let alone the capacity utilization. So we have to look at the timing of our next expansion, next phase of our expansion, which is already announced. This is the second phase of our expansion now.
So that is on hold for the time being because of what we understood last. It would probably be somewhere around H1 of 2023. That was initial
That's right.
announcement. So as of now, that's on hold, and you'll come up
That
with
is
further
not on
clarification.
hold. See, because we already have invested part of the equipment and other things for the next phase. It's only a matter of timing that we need to look at. It is. We cannot say that it is on hold. So we are just only waiting for the right timing to proceed. We have already finalized the technical specifications. Everything has been finalized, and then just we are waiting for it to kick off.
Right. Great. Thank you so much once again, Mr. Suresh. Wish you all the best.
Thank you, Bishan. I think Samir, I think you have raised your hand. You have, I think, some questions.
Hi, Suresh. Good morning.
Hi. Good morning.
I have a couple of questions as well.
Sure.
Just want to understand, although Bishan has discussed in detail about the impact on your investments, just because there's a lot of technicalities, although I didn't understand much of it. So just want to pick the core. So you are saying that the 3.2 million you put as impairment, that can still be reversed, or bulk of it can be reversed at the time of maturity. That's what you're saying, right?
That is a possibility. Yes, that's right. That is right.
And you're not expecting any further impairments?
I wouldn't say yes or no to it, because these are all depending on the underlying equity performance in the market. So I cannot say whether it will go down or whether it can go up. If everything is well, I'm sure it will go up. If there is going to be some geopolitical situation, if it worsens and things like that, there can be a chance that it may go down also. I mean, that is the ground reality.
Understood. And with these kind of returns and like risks, how comfortable are you with those investments? Do you have any plans to switch to something else right now?
Yeah, once on these maturities, probably we will be a little more, I would not say cautious, but a little more prudent, I would say, so that no, we will see. Even these kind of investments, if it is going to be buoyant, we may look at it. But then again, it is the call of the board, because once we put it to the board, I mean, ultimately it is the board's decision. But we might be a little more cautious going forward, at least till everything stabilizes for such investments. Or maybe when we are going in for the next expansion, automatically, I think we will not have these excess funds with us. So that will get into the expansion, and then probably we will be able to, our returns will be from the operational side directly.
Okay. Understood. And one follow-up question on the Saudi. You mentioned that your volume can come down, and also the realization can come down because you may have to give a high discount to your distributors.
That's right.
So since KSA market is quite, it's still growing, right? You are expecting that market to be in a growth path. So if your volume is coming down, who else would be in your view is going to compensate that, because that's still growing?
Yeah, it is still growing. See, at the end of the day, Saudi market is growing because of two reasons. One is, there is a huge redevelopment of the country. If you see Riyadh and Jeddah, both these cities have been partially demolished, and then they are coming out with, they want to change the skyline of the cities. So to that extent, there is a huge developmental activity going on, and then there is a huge demand that is going to be there. Apart from the regular demand, there is going to be this redevelopment demand in the next 1 to 4 years maximum, or 5 years. There's going to be a huge demand. So to that extent, there is no doubt that Saudi market is going to be still continue to be a big market. Having said that, the other point is that there are capacity increases in Saudi also. So which will partly compensate the growth demand, but still they have to depend on imports, where we can still look at dipping in there.
Oh, okay, understood. And what's your overall outlook on the Oman market?
Yeah, Oman market is so far quite steady, and then it is looking good with even the local budget surplus of more than 1 million. People are expecting a little more projects to be announced, and then there is quite a buoyancy in the overall market here. And then the interest rates also are quite stable here, with liquidity quite high, with all the banks. People are feeling that it is the right time to go in for their housing, building their own houses. So the overall situation in Oman seems to be quite stable. And then the steady growth is what we envisage is going to continue.
But the interest rate has been on the rise, and the CB also increased the rate as well. So how do you think that going to impact?
No, but CBO having raised it in line with the US dollar rates, but with a very, very clear rider that the banks cannot increase the rates down the line. So to that extent, they have also put a caveat saying that they cannot increase rates because they're all flushed with funds. They're all their liquidity is quite high. So I'm sure that they are not going to increase the rates just like that in the near future.
Understood. Thanks a lot. Thanks a lot, Suresh.
Okay. Thank you.
Hello?
Hello, yes.
Just one last follow-up question.
Yeah, sure.
So based on what, this follow-up to what Samir asked. So effectively, what you reported in investments or the impairment as of September 30th, you said from that level, currently as where we stand today, it's slightly above.
Yeah, it is slightly above. In fact, the impairment has reduced, I would say. The impairment has reduced, I would say.
Right. Yes. So effectively, that will be a reversal in your P&L. That's one thing. But let's say at the current level, all your sort of instruments were to mature, then the entire 3.2 would be reversed and you'll get the entire coupon. That's the way to look at it, right?
I wouldn't say that the entire will be reversed. Substantial portion will be reversed.
But if it's above this,
above the strike rate, see, as on the maturity dates, if it is above the strike rates, it will be 100% return. Yes.
Correct. So my only hypothetical question was that if today was the final maturity date for all those instruments and they were above the last reported impairment value, then they all would get you back 100 and all the associated coupons.
I wouldn't say that. I wouldn't say that. There are certain small, there are some underlyings which is hit the strike rate. So there may be a small impairment. I mean, I wouldn't say that it will be a substantial impairment like what we have disclosed. Yes, there will be still an impairment which we need to account, but there will be a reversal for sure. Yeah.
Understood. All right. Thank you so much.
Yeah. Thank you. Thank you so much. Yeah. Yeah. I think somebody else, Abbas. I think Abbas has raised his hand now.
Suresh, good morning.
Good morning, Abbas. Yeah.
Suresh, thank you very much for the call and very patiently answering all our queries. Just one question on the investment side. I mean, I know the exposure is just 10 million riyal, 30 paisa in terms of your book value, and there's a big sort of operational story that you'd like to talk about rather than focus on this. But for us, we just want to make sure that we're not in for another quarter which impacts your bottom line thanks to this. Now, just one. Are you? Let's say if these underlyings are below strike price, do you actually end up taking delivery of the equity shares, or you just make a you just make a realized loss on your principal and that's about it? You're not going to take delivery where the portfolio will be further exposed to further downside. Let's say if geopolitical situation gets worse, or who knows what's going to happen. So is there a risk of delivery?
Okay, excellent question, Bas. See, all our notes, we have very clearly that we are not going to take delivery of the equities. It will be straight away mark to market, and then we realize it as per the completely. We realize as per the formula. So there is no taking delivery of any of the. So the risk is absolutely not there. Yes.
But then what I can't understand is why would IFRS, which tends to be a pretty sort of practical sort of way of looking at accounting, why would it insist on you taking a loss based on?
We have also debated.
The loss should be based on strike price and not.
Exactly, that is right. But then unfortunately, we also have debated with several auditors, And most of them have given in all the international firms, everybody has given the same view because they have quoted the paragraph, I don't remember, of IFRS 9, which according to them has to be routed through. And world over, whoever is investing in this have been taking it through P&L only. So that is their contention. And then they also have very clearly, pointed out particular a few paragraphs of IFRS 9, which stipulates that it has to be taken through profit and loss. Yeah, because we are also of the same opinion which you had. Okay, so because that would have made sense actually, because these are all debt instruments where the maturity is going to be.
Yeah, that's strike price onwards. Correct.
That's right. That's
now
right.
Tell me this: if the underlying is below the strike price, you obviously told me the formula pretty much is the downside from the strike price is what you lose in terms of principal. Will you be still paid the coupon? Let's say if you've already accrued coupon, okay, over a period, and at the and on the maturity date, the underlying is below the strike price. If it's 60, it's 55. Will you have to reverse those coupons?
No. See, all the coupons are always accounted on these instruments on cash basis only. So which means what you have not received, you have not accounted. Okay. So to that extent, there is absolutely no reversal of
whatever you got paid, there's no reversal of coupon.
There is no reversal of coupons. Yes, that's right.
Right. Okay. And okay. So these are the couple of clarifications I needed. Now, when I look at the operational performance, there was pressure in the operating profit level. I mean, pressure is a strong word, but in the sense that there was a downside in the third quarter earnings. And you mentioned some of the reasons in this call. Now that you've got this bigger capacity on board, right? I mean, firstly, there was a bit of a delay in terms of getting this capacity up and running. Now that you've got it up and running, and you've got these couple of issues facing you're looking at margins coming under pressure, right? In terms of where you thought margins would be at the start of the year. I'm talking at the net level versus where you expect the next 12 months to be, because these resolutions don't come easy, right? I mean, of course, we are part of a GCC custom union. We'd like Saudi to sort of not put any duties on us, but it's something that is above yours and my pay grade, right? It's at a ministerial level where they have to speak to them, ask for, So what sort of new sustainable margins are you looking at, especially at a time where one, you're getting the advantage of some economies of scale because you're ramping up capacity. At the other side, things are not as as nice as they were in terms of an environment. So where do you see net margins in the next 12 months?
See, the net margin, the impact on the net margins in the last quarter was on account of two issues. It was not only necessarily because of this anti-dumping revoking and the 12% customs duty. It was also because of the impact on the inflationary part of the input costs. So all these things is what we had a pressure. I wouldn't say pressure. There was a very marginal impact on our profitability. But going forward, as you rightly pointed out, we have the additional capacities now, and the additional capacities are with larger format tiles, which is going to give us a much higher realization as such. So whatever is the higher realization that we are going to obtain from the new line, to some extent may even compensate what we are losing out in realizations, if at all, if any, in the markets like what I have discussed about KSA or UAE. Apart from that, one more thing which I would like to share is that the inflationary pressures are now softening a bit. So that also is going to help us in our input costs. Basically, on the sea freights have considerably softened now, and then we expect that it is further going to soften, and then it may almost go back to the original levels in the next 3-4 months. So to that extent, that is going to be a very, very clear advantage to us in terms of whatever we are losing out on the realization side, we might be able to make it up on the impact on the inflationary stabilization.
Okay, that's good to hear. And are you seeing more competition in the Oman market, given that there is this, Al Maha that's acquired Al Hail, and they might be operational soon? Do you feel like the market is, is there a price competition that you foresee in the market where your realizations will come down for both you guys?
Once they come into the market, see, basically they are that plant is also a porcelain plant. So as far as they are going to produce porcelain, there is not going to impact our on the competition is not going to be very huge in terms of on the ceramic side, which our entire capacity is ceramics. So we will have to wait and see as to once they start operations and then how their pricing is going to be, because it's quite a huge investments that they have put into. They have a huge debt. So all those things put together, we need to see how well they'll be able to bring in, and then whether they will be able to compete us on price, because we reckon we are one of the lowest cost producer of ceramic tiles in this region. So to that extent, we have the we have the first mover advantage in terms of cost for the last almost more than a decade now. So we will wait and see how we will have to play the game once we come there.
Understood. And you mentioned that they're on the porcelain side, and
no, partly. I wouldn't say fully. Partly,
yeah, I mean, I know the
yes,
plant has
yes,
the flexibility of changing the design,
right.
but is that something Anwar Ceramic will consider in future expansions, probably going to the porcelain side, given that, from what I hear, there's a lot of, commercial demand for porcelain, and even now housing demand for porcelain is going up, especially on the luxury segment. So is that something you would consider, or you want to stick to what you know best?
No, as of now, we have been sticking to what we know best now. Not that we will not be able to do porcelain. So we have done every time we are looking at an expansion, we certainly do consider whether we should go for ceramics or whether we should go for porcelain. There are certain barriers, I would say, which is prohibiting us from going for porcelain, especially importing of the entire raw material. None of the raw material are available locally, so you need to import it from outside. That cost of shipping it and then trucking it down to wherever it is, it's a little prohibitive. Because today, with the anti-dumping not being in vogue, either in Oman or in UAE, except Saudi. Again, Saudi, if you want to sell, again, there are people, again, there is a huge transportation cost that is involved. Whereas your immediate markets are the local market and UAE market, where there's no anti-dumping. And then the porcelain tiles, which is coming in from India and China without the duties, are ridiculously at low prices. It is sometimes even lower than the ceramic prices. So to that extent, it's going to be a challenge for them also. So them also, as well as for us to consider going for porcelain, is still not, we have not found it viable.
Got it. Very clear. Thank you. Suresh, my last question is, I mean, I know at some level you'll probably say that it's a board decision, but if you go back and look at the dividend payout ratios of Anwar Ceramic and, the moves that you made as a management to, reduce capital, there is definitely an element that, you consider shareholder return paramount, in the sense that that's definitely in the focus. Now, in a year like this, when you have, I mean, I'm hoping a sort of one-off investment impairment, which is non-cash, but who knows where it's going to end. But, for us, you work on a year-end basis, right? So let's say you're looking at 31st December 2022 and you come up with a certain earnings. Yeah. Now, what, as a company, nothing prohibits you from paying a more than 100% payout ratio, right? Because as long as you have the retained earnings and cash available to you. So there's nothing stopping you, right? Sort of.
That is right. Nothing is stopping us from that. But like you said, with Ryder saying that it is a board's decision, that is finally rests with them. Yeah.
Okay. But so the maximum dividend paying capacity is to the extent of your retained earnings. Is that
fair?
Right.
That's fair. That's a fair proposition. Yes.
And in terms of, when you look at the capital structure of the company, I mean, do you feel that there's more room for debt where you possibly could free up some equities? Because I'm only asking you because, you have in the past as a company, done moves which have rewarded shareholders, one way or the other, right? I mean, obviously operational is, you do your best operationally, but there's the environment that you have to consider. But at the company level, is that something that you feel that, my capital structure is not at the optimal level, maybe I can take on more debt? I don't know. Is that something that you guys think in that direction?
No, see, taking a little more debt and do what? At the end of the day, I cannot
give some money back to shareholders.
No, that's where I was coming to. See, you cannot borrow and reduce capital. Okay, the law is very clear that you can reduce capital only with your excess funds which you have. After providing for certain working capital for a couple of years, the law is very, very clear. The CCL is very clear on that. So based on that, our balance sheet is quite clean, and then we have a neat balance sheet. So we would like to have it that way, unless we have some excess cash. When we had it, we have demonstrated that we can return it to the shareholders so that they can get a better return elsewhere. Yeah.
Right. But as of now, okay, fine. And in terms of buyback, how is it with the new company law? Is it relatively become easier to do a buyback, or if the
No,
management feel that?
No,
Yes.
we need to understand that. I'm sure, not sure on how it works.
You haven't
And
considered,
yeah, and also, if my memory is right or if my knowledge is right, I think maximum buyback is restricted to 10% of the capital or so. Yeah.
We'll be very happy with that. No, but I understand. Thank you very much for the call, and all the very best to you. And look forward to chatting with you in the near future.
Thank you. Thank you so much. Thank you so much.
Bye-bye.
I think Bishan, you have something else?
Oh no, that's it. The hand was raised by default. Thank you so much.
Okay, fine. Thank you so much. Yeah. Any other questions, gentlemen? If there's no other question, we can wind it up. Okay, thank you. I see that there are no other questions. Thank you, gentlemen. Thank you, everyone who's attending this meeting. And then I'm sure you have been benefited from this discussion, and I am confident that whatever queries you have, we can address it in the next session when we have. Thank you so much, and then wish you a good day.